Just fix the camera. Hello, hello. Welcome to another episode of Financial Tides. I'm sure that if you're tuning in today, there's probably some fear and some concern going on with the markets and everything that's been happening the last couple of days. So we decided to do a podcast actually before the most recent market dip, kind of just in the beginning of the year, what's been happening with the news of tariffs coming and what it really means for the market dips. But in recent days, it has gotten a lot more serious and a lot more concerning. So I'm sure a lot of people are tuning in now because they've seen the account balances drop or they've seen the news. So we wanted to make sure that we got this out even quicker to address kind of what's happening and why it's happening. So today we're really going to unpack how it has shaken up the markets and then what it means for long-term investors and kind of what it means for you as a whole. So we're going to start with the very basics, very granular with what is a tariff. For those of you who don't know, a tariff is a form of tax on a good that's being imported or exported into a different country. So, one of the big ones that you've probably heard about is German automakers here in the US that they want to have a larger tariff on it. So, that's kind of a large example of something that might have a tariff and how it can lead into the United States and face a rising cost. So, for example, if that tax is imposed on a German car, say a German car is $50,000 and now there's a new tariff on it, there's two real ways that the tariff can be addressed. Either that German automaker can take it on the chin and say, hey, that's just going to come out of our profit margin. We can't really sell our cars for anything higher than we're selling them now, or they can pass it forward to the consumer, which would say, "Hey, we're getting charged an extra 10,000. We're going to need to pass that 10,000 along, so we're going to charge $60,000 for the car that we were just selling for 50,000." So that's kind of the first place I'd like to start with talking about these tariffs and thinking about what they are and what they're doing because this sell-off that we've seen on the heels of tariffs is basically saying really one of two things. It's either saying that, hey, these companies are going to have to take it on the chin and say, we're going to have a lower profit margin, which would make sense for having then a lower a lower stock valuation because they're going to have less profits, so they probably shouldn't be valued as high. Or the second of the two things, which is that these companies now are going to have to charge more for their products, which seems to be kind of the general consensus of what's going to happen. Which is why when we're kind of looking at the general markets, the international markets haven't done as poorly as the US markets. It seems like it's the US markets that are starting to sell off, which would point more towards people believing that we're just going to have to pay more for everything here, and it's going to create problems as far as how much we can spend and what we do. So that's kind of what the general consensus is right now. So I figured I'd kind of point that out with tariffs to kind of frame the whole conversation of what's really happening here in the stock markets and kind of why we're seeing that sell off more on the US side than some of the other sectors like the international side. So using that as a bit of a segue, let's jump into this recent market sell off. So, tariffs went into place, the main big Liberation Day, whatever you want to call it, tariffs went into effect at the beginning of April here, April 2nd. None of this is pointed towards any economic data that we actually have. So, when you see the market selling off, it's not selling off the fact that tariffs have already crushed the US economy and that it's doing well. It's kind of more of a forward-looking thing, saying that we believe that tariffs are going to crush the US economy, make it harder for us to buy goods here. Products aren't going to do as well here, and our products, if there's reciprocal tariffs, are going to be harder to sell around the world. So that's kind of the first point is that while there has been a recent market sell-off, none of it is based on actual economic data. There's no economic data released on these tariffs. It's too soon to get anything like this or figure any of this out yet. So the real reason that it's selling off is more fear-based, which I think that because it's forward looking, the fear of what it could do and the uncertainty, because we haven't had a tariff or a trade war quite like this, really ever. And that comes back to why it's fearful is people don't know how to react, which it's okay to be fearful. I think there's a valid point to that, and there's some reason to be concerned. I don't think that it made a lot of sense to be doing reciprocal or tariffs on basically every single country in the world all at once, and then having to try to come back and negotiate with everybody at once instead of picking a few bad ones that said, hey, we want to get a better tariff deal in place with these. And then once you have those deals in place, you move on to the next group, just so there's a little less shock and a little less uncertainty. Fewer countries that can all band together now and say, hey, if we all do reciprocal tariffs, then the country that's going to be hurting is the US, and we can kind of all band together and trade with each other instead of the US in the short term to keep us afloat. So I think there's a little bit of that and truth to that, but we're at the point where we're at now, regardless. So we kind of have to make sense of what we have and how we can move forward. And I think a lot of this, while it causes fear, I think that it's short-term fear. And I think that's the big point of tariffs is that one of two things is really going to happen. We're either going to go 3 more years with tariffs and the whole country is going to be so fed up that there's going to be change in Washington, or on the flip side of that, these tariffs are going to work. They're going to be negotiating tools and people are going to start making deals. I said this morning that I think that if we wanted to get some deals in place quicker, that we should have came out and said, hey, the first countries to make a deal are going to have the best deals and the ones that lag behind are going to get whatever deal they can get at the end. But get some incentive to get countries to the table negotiating and working out deals quicker, just so that the U.S. can start seeing that, hey, these tariffs are working and they're causing people to negotiate and make trade deals. I heard the announcement today that they already have 50 different countries that are at the table talking. So maybe they don't need to do that as much as I thought they would initially, but hopefully a couple deals in place will start getting things kind of on the right track and alleviate some of that fear that people are feeling right now, because that's what this is so far. It's just fear. Fear for the worst, kind of the same thing that happened with the pandemic, where when the pandemic hit, everybody said, hey, people aren't going to be living the way we used to live before. People aren't going to be going to gyms ever again. People aren't going to be doing this. And a bunch of things sold off and a bunch of things did really well for the pandemic trade for a very short amount of time. And things changed. So I think that's again that sometimes market sell-offs are overreactions and it takes a little bit for things to normalize. So I'd keep an eye on that as far as the market sell-off goes. I don't think that it's time for panic. I think it's more so time to buy the dip. So what does buying the dip mean? It means things went on sale. Things are now not at the all-time highs. We've heard so many people telling us how fearful they were to invest at all-time highs. Now's your chance. There's a great buying opportunity that just happened, especially when it's something that we think is more fear-driven than based in actual economic data at this point. If you have an opportunity to buy those same companies that have done so well and continue to do well, at a discount from where they were 3 days ago, 4 days ago, I think it makes a lot of sense for those that have money sitting on the sidelines. This isn't broad investment advice, but if you say that you have a long time horizon and you're willing to take some volatility, I think it's a great time to be deploying loose cash and dollar cost averaging into the market while things are even cheaper. So all those young folks like myself that are adding money to a 401k, I wouldn't stop that just because you're fearful. Most of you have 20, 30 years before retirement. And I think it's a great time to not worry about the stock market and let yourself buy some stuff while it's on sale. So, quick break here for water. Okay. So next is kind of the tariff inequalities and kind of how they're not a straightforward way because they kind of have a lot of things playing at the same time. And there's a lot of different things going on right now outside of tariffs that I think will be possible offsets to the actual economic impact that tariffs may actually have. So, the first thing is the idea of tariffs. So, the idea of tariffs is to make it harder for other countries to compete in our market, which just so happens to be the biggest consumer market in the world, which is kind of that leverage point of why we can charge tariffs on other countries, is that if they want to operate in the largest market, they're going to have to do it by paying us or as a bargaining chip. So the other side of this is bargaining chip of trying to get a more competitive balance of our products versus their products. That's both us creating more stuff domestically and making more jobs, which in theory should boost or should grow the economy overall, which there's just some things that we're just not going to make in the US ever. So that's why we need to import. So we need to be logical there and have key trading partners with good deals in place to get the stuff that we just aren't going to produce here in the United States and can't produce it. For an example, clothing. I don't see us ever having clothing factories really here in the US. It's just way more expensive to run and operate. So we're going to need to import those from somewhere. But then also on the flip side, um, kind of encouraging the growth in the US of what we do have should create more dollars coming in that kind of offsets whether it's tax revenue or whether it's actual dollars that the consumer is spending. It should offset some of the prices that may or may not increase as a result of these tariffs on the things that are coming into the country. So I think it's kind of a catch 22 of it's going to take a little bit. You're going to feel some pain short term as far as some prices may go up, but hopefully we're going to grow the economy at a rate. And the economy is different from the stock market, just to make sure that we're not talking about the same two things here. The economy tends to be or the stock market tends to be a leading indicator just because of the emotion. But yes, we think that hopefully long term we can grow the economy enough to offset some of these price increases that may come of the tariffs if they stay in place long term. Kind of impact of tariffs on the overall stock market, which with these last couple days, you're gonna be shocked when I say this, but it is true that the growth stocks tend to be the most resilient of the companies to tariffs, which I think further confirms the fact that this sell-off is highly emotional because the Mag 7 are the companies that have actually done the worst in this scenario with tariffs. And that's just because they're the biggest part of the market. They're the biggest things that have gained recently. And when people start seeing the stock market go down, they're going to cut their losses and try to get out of the things that have done well recently when they start going down in big numbers. So that's the whole selling leads to more selling type of thing. We'd never get emails leading up to the couple of days of the market being down. After this, we're getting tons of emails saying, hey, should we get out? Should we go to cash? And no one's long-term strategy has really changed in the matter of this. It's just, again, the emotion is driving people to sell. So now that we had a big sell-off, more people are selling, which is extending the sell-off from the actual reality of things. So I think that you'll see the short term and the inflationary side of things, but really growth stocks and the larger companies have a lot more ballast at the end of the day to be able to keep up with some of these issues and be able to pass through some of the expenses, which again, passing through the expenses, if we grow our own economy, isn't the end of the world. We just need to make sure that we're growing in other areas outside of just those imported goods and areas. So moving on to the valuation gap. And I think this is really kind of where the markets have gone this year and why it's different, even with the tariffs in place. But the Magnificent Seven stocks and the broad market and international stocks are vastly different than where things are with each other. So if you look at them comparatively speaking, the Magnificent Seven stock is valued at a much higher clip. PE ratio, price to earnings, is typically the base level evaluation that you use to kind of see if the price is fair to the earnings that that stock is actually generating. So the broad market's price to earning ratio is right around the 20 to 25 range, where the Mag 7 is 30 to 50% higher. And that price to earning ratio doesn't tell you the whole story because the Magnificent Seven, the reason why they're so much higher typically is just they're forecasted for a lot more growth. They're big companies that have the ability to grow and continue growing. So they're getting a little bit of a higher valuation just based on the fact that they can push growth more and be more efficient, whether it's using AI and everything. So they have a higher growth trajectory that creates into some of that higher factor. But this trade that's done extremely well this year so far is international, and they have a very low price to earnings ratio, really between 10 and 20. So we're talking about pretty steep discounts. And we think that a lot of this is back to the whole diversification that we always push and we always believe in is that something's going to be doing well at some point, and you just need to own a little bit of everything. And international has done well this year. And it might be because it was before the tariffs went in place, but it might be because it's just undervalued as a whole compared to some of these huge, magnificent Steven stocks that have done nothing but shot up the last couple years and shot up at a higher clip than the rest of the market and made this price to earning ratio gap even larger than it is now. So I think when people look around and try to figure out what happened, some people will try to attribute it to the tariffs, but I just think also the price valuations of international were far, far lower than a lot of the other things that people could invest in the United States. So it kind of peaks the growth and peaks the shift. And it was something that we saw before the elections that the price to earning ratios were pretty steeply different. And it's something that we make minor shifts on for you before this, just like we were trying to be less overweight in the Magnificent Seven stocks in our portfolios, just because they've had their day in the sun. We don't need it. And I think if you look at a lot of your portfolios in comparison to the overall market, NASDAQ specifically, that we are not anywhere near the Magnificent Seven exposure, and we have very little, comparatively speaking, to the broad markets just because they've had their day, they've had their run. And it was a move we made in late November, actually, that we really wanted to be out of the stuff that has had its day and be very diversified. And we think diversification, as always, is the best strategy. You can stay long term with it. You don't have to worry about what tomorrow brings. And I don't think we have to worry about these tariffs. I think that's the big thing with our bucket strategy is that we very much have our assets lined up with our liabilities. So if you're going to need something short term, we're not invested in the stock market with that. We're not worried that the tariffs are going to be there. And if we can survive, again, I think 3 years, we'll either have this working or we'll have a big wholesale change across Washington. So all you really have to do is get through 3 years of your assets and give it a chance to recover. And I think that the bucket strategy has lined everybody that might be listening to this or will listen to this in the future and become a client. I think that they are positioned well or will be positioned well to last 3 years without having to sell assets that are going up and down with the stock market if they're following the bucket strategy. So I think there's nothing to worry about at this point in time. I'm happy to hear all your concerns, anyone that wants to call in and talk in more detail about it. But I think that the pendulum swings, and with tariffs right now, they've swung to one extreme. It's going to have to swing back one way or another. And I think that's going to come sooner rather than later. I think there's also going to be other areas of the economy that are, or other areas of policy that will offset and stimulate the economy. I know they're talking about a tax bill right now. So if the tax cuts get locked in for a bit longer or something similar, I think that's an area that will then extend the economy here in the US as far as that goes. And then there's Fed policy as well. The Fed still has room to cut interest rates further, which I think is good because we were at one point where there was nowhere to go when interest rates were at zero and they couldn't cut any further. This time we actually have some wiggle room and some flexibility to help avoid actually going into a recession. So I think that all of this will bode well, hopefully, for the short term, but also the long term in making efforts to try to uh, get the US economy to be stronger and in turn, hopefully, get our stock market performance to be stronger as well. So that's all I have for today. If you have any questions, concerns, please feel free to reach out. We're happy. We love talking with everybody about all this stuff. It's what we do. And don't forget to hit that subscribe button and tune in for the next episode of Financial Tides. Thanks so much.
John Perillo and Taylor Perillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice.